Imagine waking up, pouring your morning coffee, and checking your phone only to find out your auto insurance bill just dropped by 20%.
Oh, that would be nice.
Right. But not because you turned another year older, not because you moved to a different neighborhood or got married.
Right, the usual reason.
Exactly. But because while you were sleeping, your car downloaded a software update over your home Wi-Fi, and its digital brain just became a statistically safer driver.
Yeah, I mean, that sounds like science fiction.
Or maybe a pitch from a tech CEO 10 years in the future.
It really does sound like a futuristic thought experiment.
Hmm.
But the reality is, well, this exact scenario is currently reshaping one of the oldest financial sectors in the world.
Which is pretty wild to think about.
It is. We are watching the complete dismantling of how risk has been calculated for, the last century.
Which is why we are taking a deep dive today into this massive collision of artificial intelligence, autonomous vehicles, and the legacy insurance industry.
Yeah, there is a lot to cover.
There really is. We have a stack of recent financial Q&A session transcripts from Lemonade.
Right, the InsurTech company.
Exactly. They're an insurtech company attempting to challenge the massive legacy insurance giants. Our mission today is to shortcut your understanding of how treating AI as a literal physical driver is fundamentally rewiring the underlying math of financial risk.
And we are going to use their raw financial data to look past the typical Silicon Valley buzzwords.
Because there are a lot of buzzwords.
Way too many. This isn't just about flashy cars. We're looking at hard financial metrics to understand how automation is driving down overhead, stabilizing reinsurance, and carving a clear path to profitability.
Yeah, and if you're listening to this and thinking a corporate financial earnings Q&A sounds like a cure for insomnia, stick with us.
I promise it gets interesting.
It really does. This is a direct window into the future of data and automation. Understanding this shift affects how companies will scale over the next decade.
And frankly, it is going to directly impact how you pay for your own life.
Absolutely. Okay, let's unpack this. We'll start with the most surprising revelation from these sources.
The AI pricing model.
Right. The transcripts detail how Lemonade is pricing insurance per mile and per driver, but they are specifically recognizing different versions of AI software like Tesla's autopilot as drivers themselves.
Yeah, they are essentially issuing a policy to a piece of code.
Which is just wild.
It is. They aren't just lumping all smart cars into one generic discount category. They are looking at the specific version of the autonomous driving software running the vehicle.
So wait, a car running version 10 of a software suite might get a different rate than a car running version 11?
Exactly, because the data shows version 11 makes fewer errors.
Wait, so they are treating a software patch the same way a traditional company treats a teenager aging into their 20s?
It is the exact same concept, yeah, just operating at the speed of code.
That is fascinating.
And the results they're reporting from this strategy are massive. Like for these specific AI-driven policies, they are seeing a 70% increase in conversion rates.
70%.
Yeah. Customers are flocking to this model because it finally acknowledges the safety capabilities of the technology they paid for. I mean, that conversion rate is almost twice as high as their historical average.
Okay, I have to stop you there because looking at the actual roads right now, this feels like it could be a massive illusion.
How so?
Well, fully autonomous vehicles or even cars utilizing advanced AI driving systems, they make up a tiny fraction of the market. The vast majority of people are still steering their own gas-powered sedans.
That is true.
So isn't focusing entirely on AI drivers just a clever PR stunt to get free media coverage by name-dropping Tesla while completely ignoring the reality of the current consumer market?
Well, what's fascinating here is the underlying math of being a market disruptor. You are entirely correct that the current adoption of level 3 or better autonomous vehicles is, statistically insignificant for the broader industry.
Level 3 meaning what exactly?
Meaning the vehicle can basically drive itself under specific conditions, like highway cruising. But a human driver still needs to be in the seat, alert, and ready to take the wheel if the system gets confused. Yeah, that level of tech is still rare. The rollout of this specific AI as a driver policy is happening slowly, state by state. But you have to look at Lemonade's scale compared to the legacy giants.
Yes, the big guys.
Exactly. The incumbents,
Yeah.
your Geicos, your Progressives, are $50 to $70 billion companies with massive entrenched bases of traditional drivers.
And Lemonade is a fraction of that size.
A tiny fraction. I mean, they estimate their market share is less than 1 per mil compared to those
Less
chains.
than 1 per mil.
Yeah, a tenth of a single percent. Because of that size difference, they do not need the entire world to buy self-driving cars overnight to see a massive financial benefit.
Oh, I see.
The adoption curve for new automotive technology, whether it's seatbelts, airbags, or anti-lock brakes, historically moves very slowly for a decade, and then suddenly it becomes ubiquitous almost overnight.
So they are basically building the plumbing for a house before the neighborhood is even finished.
That is a great way to put it. They are ensuring they are structurally ready for that exact bend in the adoption curve.
Makes sense.
For a giant incumbent, a slow, fractional rollout of AI cars doesn't even move the needle on their quarterly earnings. They have absolutely no incentive to overhaul their mainframe systems for a tiny niche.
Right, why bother?
Exactly. But for a smaller disruptor, having 2 or 3 years of actual mathematical autonomous pricing experience under their belt before the massive wave of adoption hits is a monumental structural advantage.
Because they'll have the data.
Yes, they will understand the risk profile of the algorithms better than anyone else.
Okay, that makes sense from a long-term strategy perspective. But if they are just waiting for the future to arrive, how are they surviving right now?
Well, that's the thing.
Because the sources show this tech isn't just sitting idle. The exact same infrastructure they are building for autonomous vehicles is currently revolutionizing how they evaluate human drivers today.
Exactly. We are moving from the niche world of future autonomy into the broader, everyday auto insurance market that affects everyone.
And the numbers in the source material regarding this are staggering. I mean, over 90% of their current customers have continuous telemetry turned on.
Which means the company's app is actively tracking the physical driving behavior of those users via their smartphones.
Every single time they drive.
Every time. It measures how hard you brake, how aggressively you accelerate, how fast you take corners, and the exact number of miles you drive.
Now, here's where it gets really interesting, because the CEO explicitly refers to this telemetry as having X-ray goggles into actual driving behavior.
That's a strong visual.
It is, because if you think about how legacy insurance works, it is essentially like a teacher grading your final exam based entirely on your zip code, your marital status, and your credit score.
Right. They never actually look at your answers.
Exactly. They just look at broad demographic proxies and assume your grade.
That is the perfect way to describe the old model. It relies entirely on correlation, not causation.
But continuous telemetry is the teacher actually standing over your shoulder and watching how you solve the math problems in real time.
Which changes everything.
It does. They're abandoning those broad demographic proxies entirely. And it is driving massive growth. The transcripts show their car insurance business went from negative growth a couple of years ago to 9% growth last year to a massive 60% growth rate in this most recent quarter.
60% is huge.
It's massive. Car insurance now makes up a full third of their sales. But surely there is a ceiling to this. I mean, if you ask the average person if they want a massive financial corporation tracking their physical movements 24/7, most people are going to say absolutely not.
Right. Privacy concerns.
Yeah, isn't this level of tracking too invasive to ever achieve mainstream scale?
It is a totally valid tension, and it is something the entire tech industry wrestles with regarding privacy. But the transcripts reveal a counterintuitive reality. Despite this intense, continuous tracking, consumer trust is not eroding. They're seeing organic sales grow rapidly, and their net promoter scores, which measure how likely a customer is to recommend the brand to a friend, are actively rising.
Really? People are recommending it more.
Yeah. They even note they've become the #1 most searched brand in pet insurance, which is a strong indicator of broader brand affinity and trust across their product lines.
So the customer is essentially saying, I will trade you my privacy if you give me a fair price.
That is the core trade-off, yeah. From an analytical perspective, this continuous telemetry is a structural advantage that allows them to de-average big, monolithic groups.
De-average meaning what?
Well, say you are an incredibly safe driver, but you happen to have a poor credit score, or you live in a zip code with a lot of accidents. Legacy insurance penalizes you heavily.
Even if you've never been in a crash.
Exactly.
Yeah.
You end up subsidizing the bad drivers in your demographic. Telemetry breaks that dynamic. It prices you based purely on your individual actualized risk.
Wow. Okay, so telemetry solves the problem of charging the right price up front. But the real test of an insurance company isn't when things go right.
No, it's when things go catastrophically wrong.
Exactly. So let's look at the financial plumbing of the back end. If their AI is so brilliant at calculating the price of the policy, what actually happens when that driver inevitably slides on black ice and hits a lamppost?
A great question.
Does this technology actually save the company money during a crisis?
The short answer from the transcripts is an emphatic yes. The financial metric to watch here is called the LAE, the Loss Adjustment Expense Ratio.
Loss adjustment expense.
Right. This measures the cost of managing, investigating, and adjudicating a claim as a percentage of the earned premium.
Let's break that down for someone who doesn't live in spreadsheets. A legacy insurance company gets a claim. They have to pay a human call center worker to take the report,
Yeah, and then they have to pay a field adjuster to drive a company car out to a body shop.
inspect the bumper with a clipboard, argue with the mechanic about the cost of a headlight, and then manually authorize a paper check.
Exactly. All of that overhead is the loss adjustment expense.
Right. And Lemonade's LAE ratio is currently sitting at 6%, which they consider to be best in class for the industry.
Best in class by a wide margin.
But how is it possibly that low?
Because they have replaced the vast majority of that human friction with AI-powered automation.
So no adjusters driving out to body shops.
Nope. Instead of waiting days for an adjuster, the user uploads a video of the damaged bumper through the app. Computer vision algorithms instantly analyze the footage, cross-reference it with real-time parts and labor costs in that specific zip code, run fraud detection protocols, and, well, in many cases, automatically approve and wire the payout in a matter of seconds.
Seconds. That is insane.
Yeah, they're adjudicating complex claims without a single human ever touching the file.
That sounds incredibly efficient. But the sources also address a weird quirk in their data. Historically, this company has a higher rate of denying claims than legacy insurers.
Yeah, they do.
And to a consumer, a high denial rate sounds like a massive red flag. It sounds like an algorithm program to just say no to save a buck.
It does sound alarming on the surface, I completely agree, but the Q&A transcripts provide vital context here. You really have to look at the mix of the products they sell.
Okay, what kind of mix?
Well, renters insurance makes up less than 30% of their total premium revenue, but because it is so cheap, it makes up a massive volume of their actual physical policies.
Right, you might pay $15 a month for renter's insurance versus $150 for car insurance. So you need 10 renter's policies to equal the revenue of one auto policy.
Exactly. And because they have this massive volume of low premium renters policies, it naturally skews their overall denial rates higher.
But wait, why does renting an apartment lead to more denied claims?
Because a significant portion of those customers are young and, well, entirely new to purchasing insurance. They don't fully understand how deductibles work.
Oh, I see where this is going.
Yeah, they might drop their laptop, cracking the screen, and file a claim for $300. But their policy has a $500 deductible.
So the AI instantly denies the claim because the damage is below the threshold of coverage.
Precisely. It isn't that the company is aggressively fighting valid catastrophic claims. It is that the sheer volume of young, digitally native renters base generates thousands of non-actionable, low-value claims.
That makes total sense.
The critical takeaway is that even with this noise in the data, the actual cost to handle claims, that 6% LAE ratio, remains incredibly strong. Their car segment, LAE, is now matching that overall 6% average.
Wow. And there's another major back-end shift happening regarding their reinsurance.
Right, the ceding rates.
Yeah. For anyone unfamiliar, reinsurance is essentially insurance for the insurance company. When a company writes a bunch of policies, they don't want to hold all that risk themselves if, say, a massive hurricane hits.
No company wants that much exposure.
Exactly. So they pass off some of the risk and some of the premium revenue to a larger global financial backer.
And the metric that tracks this is called the ceding rate, the percentage of business they give away.
Mm.
And that rate is dropping dramatically.
Really? How dramatically?
It peaked at 55% last year. In the first quarter of this year, it dropped to 30%.
That is a huge drop.
It is. They expect the second quarter to be around 25%, and they plan to normalize at a flat 20% by the third quarter.
Which means they are keeping way more of the risk and the reward for themselves. If you're listening right now, you might be wondering why a company's ceding rate matters to you.
Right. It sounds very inside baseball.
It does, but this is the ultimate proof of conviction. By keeping the risk on their own balance sheet, they're putting their own money where their AI's mouth is.
Exactly.
They trust their underwriting telemetry enough to hold the bag without a safety net. But that brings up a massive contradiction in these sources.
Let's hear it.
While I'm looking at these numbers, 60% growth in auto, a 6% best-in-class claims expense, passing off way less risk to reinsurers.
All good things.
Right. Yet the sources reveal their gross combined ratio is sitting at 138%.
Yeah, that number stands out.
A combined ratio over 100 means a company is paying out more in claims and expenses than it is taking in from premiums. So what does this all mean? Despite all the AI magic, aren't they still just hemorrhaging cash?
Okay, if we connect this to the bigger picture of corporate finance, you have to look at the timeline of a hypergrowth tech company. A 138% gross combined ratio sounds disastrous in a vacuum.
It sounds like a failing business.
It does. But the transcripts highlight that this actually represents a massive 60-point year-over-year improvement.
Wait, a year ago they were hovering near 200%.
It was significantly worse, yes. But you have to separate the actual claims from the growth expenses. Their gross loss ratio, the actual physical money paid out to customers for covered accidents, is down to a very healthy 52%.
Oh, okay. So the claims aren't the problem.
Right. The reason the combined ratio remains over 100 is heavily tied to how they account for acquiring new customers. They expense all their customer acquisition costs entirely up front.
Ah, I see. So if they spend $500 on marketing to get me to buy a policy today, that entire $500 hits the ledger this quarter, even though I'm going to be paying them premiums for the next 10 years.
Precisely. It creates a temporary headwind on their current balance sheet. It makes them look less profitable today because they're growing so fast.
Because they're acquiring so many new customers all at once.
Exactly. But the underlying math of the actual insurance product is sound, and it's pointing in a very specific direction. The leadership states they are entirely on track for EBITDA break even by the fourth quarter of this year.
Okay, let's translate EBITDA for the listener. Earnings before interest, taxes, depreciation, and amortization. In plain English, that means the core operations of the business selling policies and paying claims will finally stop burning cash.
It means the machine sustains itself, and hitting that break-even point in Q4 will trigger a rising net book value. They project that GAAP profitability, which is the strictest, most standardized measure of accounting profitability, will inevitably follow as those upfront acquisition costs are dwarfed by the recurring premium revenue.
Okay, that makes the 138% number much less terrifying. But that naturally makes me question their operational runway. I mean, they are guiding for over 30% overall growth this year.
Which is aggressive.
Very. If you are growing at that blistering pace, how does the whole machine not fly apart? How do you prevent your expenses from spiraling completely out of control?
Well, the leadership team breaks their expenses down into 3 distinct buckets, and understanding how these buckets interact is crucial to understanding their massive operating leverage.
Okay, what's the first bucket?
The first bucket is variable costs. This is about 31 to 32% of their expenses, and it scales directly linearly with the business.
So things like state premium taxes or credit card processing fees. You sell a policy, you pay the 2% swipe fee to the credit card company. There's no escaping that.
Correct. The second bucket is fixed costs. This includes salaries, legal teams, compliance, and general corporate overhead. And here is where the continuous telemetry and AI automation truly shine.
How so?
The transcripts highlight an incredible statistic. Over the last 3 years, their total employee headcount has actually declined, even as their total premiums have doubled or tripled.
Wow. That is insane operational leverage. To go back to our factory analogy, it's like deciding to triple the output of your assembly line, but you actually fire a portion of your workforce because the robots are handling all the new heavy lifting.
Yes. It proves that technology isn't just a gimmick, It fundamentally decouples revenue growth from headcount growth.
Which is a holy grail for a tech company.
Absolutely. Then the third bucket is discretionary costs. This is entirely at their choosing, and is mostly comprised of growth spend marketing, advertising, and customer acquisition.
Yep.
They justify pushing this spend up aggressively every quarter because they maintain a very high LTV to CAC ratio.
Lifetime value to customer acquisition cost, meaning if they spend that $500 to acquire me as a customer, their data proves I will stay with them long enough to generate thousands of dollars in lifetime profit.
Yes. Coupled with what they describe as an essentially unlimited total addressable market. Almost every adult legally requires some form of insurance.
I understand the logic, but I have to push back on one massive expense line item that stood out in the transcripts: stock-based compensation.
Ah, yeah.
The sources show they just raised the base level of their stock-based compensation by $20 million, establishing a new baseline of $95 million for founder and employee grants.
It's a big number.
$95 million in stock being handed out while the company is still technically losing money. How does leadership justify that to their shareholders?
It is a staggering number at first glance, but they clarify the context of the vesting schedules. These are not overnight cash outs. These are long-term retention grants.
So they can't just sell it tomorrow.
No, not at all. The standard vesting period for a normal employee is 4 years. But these specific large founder grants operate on an 8-year vesting view, with heavily performance-based milestones over the initial 2 years.
Meaning the stock literally has to perform well for the founders to ever see that money.
Exactly. It aligns their compensation with the long-term health of the company. And when you zoom out and look at the math over a 5-year period, their effective dilution rate, which is the actual impact of issuing those new shares on current investors, remains extremely healthy at roughly 2%.
Oh, just 2%.
Yeah, they argue this burn rate scales beautifully as a percentage of their rising revenue and gross profit.
Okay, the dilution isn't terrible, but let's look at that third bucket again, the discretionary growth spend. Are they just brute forcing their way to 30% growth through incredibly expensive direct-to-consumer Facebook and Google ads?
That's a common concern.
Because buying your way to the top isn't a sustainable long-term moat.
This raises an important question, and it is the exact question analysts ask regarding their quality of growth. While they do heavily invest in direct-to-consumer advertising, the efficiency of that spend is proven out by 2 other critical metrics.
Which are?
First, their indirect partner channels are thriving. They're securing high-volume referrals from places like Chewy, home security sites, and massive property managers.
Oh, that is brilliant. When someone buys a 50-pound bag of dog food on Chewy, you instantly offer them pet insurance at checkout. The acquisition cost is incredibly low.
Exactly. And second, their cross-sales to existing customers have nearly doubled year over year.
Meaning that 20-something who bought a cheap renter's policy 3 years ago is now coming back to buy an auto policy because they finally bought a car.
Yes. They aren't just buying an immediate sugar rush of clicks from an ad campaign. The overall brand visibility, which is heavily aided by the free media generated from their Tesla and autonomous vehicle announcements we discussed earlier, is creating a long-tail cumulative effect.
It builds on itself.
Right. People remember the brand, the app is already on their phone, they trust the user experience, and they buy more complex, higher-margin products over time, without the company having to pay a massive acquisition cost for that second or third policy.
Wow. Okay, let's pull all of this together and synthesize what this means for the listener. Because what we are really watching here is the real-time transition of a massive traditional industry.
It really is a paradigm shift.
We are watching the shift from an economy that relies on blunt human proxies, like judging your driving risk entirely by your credit score or your zip code, to an economy utilizing precise AI-driven telemetry that actually watches what you do.
And the financial data from these Q&A transcripts definitively proves that this automation is not just a tech gimmick designed to impress venture capitalists.
The numbers back it up.
They do. It is fundamentally driving down the overhead of processing claims. It is allowing them to retain more of their own financial risk by stabilizing their reinsurance needs, and it is paving a very clear, mathematically backed runway to actual profitability by the end of this year.
If you are listening to this, whether you are evaluating a tech startup for your investment portfolio, managing a team and trying to figure out how to scale your output without doubling your headcount, or literally just paying your own car insurance bill every month, understanding this shift is crucial.
It affects everything.
We are moving headfirst into an economy based on telemetry data. The companies that can process that continuous data efficiently will mathematically outcompete the ones still trying to read the covers of the books.
The structural advantages of telemetry compound over time. The longer they track the data, the wider their competitive moat becomes against the legacy giants.
And I want to leave you with one final, slightly provocative thought to ponder. We started this deep dive by talking about how this company is pricing a specific version of an AI algorithm as a distinct driver.
Right, the Tesla software patch.
Exactly. If an insurance company can successfully do that, and over the next 10 years, that algorithm proves to be mathematically safer, more predictable, and substantially cheaper to insure than an erratic, distracted human being.
Oh, I see where you're going with this.
At what point does driving your own car stop being a standard American freedom and start becoming a massive financial luxury that only the rich can afford to insure?
When the telemetry eventually proves the robot is undeniably safer than you are, the monthly premiums will absolutely reflect it.
Something to think about the next time you get behind the wheel. Thanks for taking the deck dive with us today.